The stock market is overly concentrated in just a small group of mega caps. In fact, the top 10 stocks in the S&P 500 now make up over 40% of the entire index. Everyone's fighting over the same handful of stocks. And hey, I'm not knocking NVIDIA, Tesla, and Amazon alike. I actually own some of these, but they're overcrowded and most of the easy money from the early years has already been made. In contrast with those stocks, some of the most promising tickers in the entire market right now are receiving next to no coverage. And what's even better is they aren't trading for hundreds or thousands of dollars per share. You can get many of them for $35 or less. By the way, I'm not talking about obscure penny stock gambles or junk stocks here either. The tickers I'm showing you today all rank in the top 5% based upon their proven fundamental criteria. And while they don't receive a lot of news coverage, they actually enjoy ample praise from some of Wall Street's top analysts, experts who are pounding the table on their upside potential. By the way, I'm Steve Reitmeister. I spent over a decade as the editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen. I'm proud to share that our quant team built the Zen Ratings quant model that analyzes every stock across 115 factors covering things like growth, value, momentum, financials, and much, much more. If you like finding stocks before the rest of the crowd does, hit that like button down below. I make detailed breakdowns just like this one each and every week, and liking the video is a clear signal that I should keep on doing that in the future. Let's jump straight into our first pick, which is Veracyte with the symbol of VCYT. This stock has been seeing significant volatility of late, so by the time you get to watch this, it might be slightly over or slightly under $35 per share. Why should you even care about this one? Because Veracyte is solving one of the most expensive and unnecessary problems in cancer treatment and making a fortune in the process. When a doctor finds a suspicious thyroid nodule or inclusive prostate biopsy, the traditional next step is often surgery. But a huge percentage of those surgeries turn out to be completely unnecessary. The growth was benign. The patient went through an invasive procedure and spent thousands of dollars, dealt with weeks of recovery, all for nothing. All right. Veracyte built a diagnostics platform powered by genomic sequencing and AI that can tell doctors with very high accuracy whether that nodule is something to worry about or not. No surgery required. They now cover thyroid, prostate, breast, bladder, and lung cancers, and they've served over 800,000 patients since inception. That barely scratched the surface on the addressable market. Thus, no surprise that revenues are accelerating greatly. They're also launching 2 brand new products this year, Prosigna for breast cancer and True MRD platform for minimal residual disease testing. These are entirely new revenue streams that aren't even fully baked into the current numbers. Now, the Zen Ratings quant system gives Veracyte an A grade as it ranks in the top 3% of all stocks we track based upon the strength of its fundamentals. Analysts are expecting to see earnings growth of about 71.3% in the year ahead. This leads to Veracyte being in the top 20% of all stocks based on their growth component grade. However, the strongest area here for the company is in sentiment. In this category, Veracyte ranks in the top 2% of all the equities we track. This tells you that the smart money is already on board. Wall Street analysts are also pounding the table on shares, given that the average price target implies 30% upside this year and likely much, much more in the years ahead. So what's the risk? The PE ratio is elevated around 110, so this is a stock where you're paying a premium for growth, and if they stumble on execution, that valuation can compress quickly. The forward PE is gladly much more reasonable at just 25 times earnings. Thus, if they do fulfill those growth expectations, then you are in for a real treat. All in all, this is a company with a massive and growing addressable market, new product launches, and the kind of precision medicine tailwind that isn't going away anytime soon. At current prices, the quantitative data, and the Wall Street commitment says the odds are firmly in your favor with these shares. Next up, we have Universal Insurance Holdings, UVE, Universal Rights Homeowners Insurance primary in Florida. Yeah. Sounds kind of boring until you realize there's an interesting dynamic playing out here, so stay with me for a second. The Florida insurance market went through an absolute crisis over the past few years. Fraud, litigation, abuse, companies going bankrupt left and right. But legislative reforms have started to stabilize the market, and companies that survived, like Universal, are now operating with less competition and better pricing power and better earnings growth. They're among the last ones standing, and they're getting rewarded for it. Insurance insurance doesn't usually get the blood pumping, but UVE is currently the top-rated stock in the property and casualty insurance industry. It's never a bad idea to own the best stock in a favorable industry group. In terms of the fundamentals, it ranks in the top 1% of all 4,600 stocks we track. That is rarefied air indeed. Universal also ranks in the top 10% for value. The same goes for sentiment and our artificial intelligence rating, which means that our in-house neural network is picked up on signals pointing to probable near-term outperformance for these shares. But I'm not here to just discuss what our system says about the stock, so let's take a look at some of the objective metrics like trailing PE, which is slightly above 7. That means it's an outright steal. Only one Wall Street analyst covers the stock, but gladly it's Piper Sandler's Paul Newsome, who ranks in the top 9% of all analysts when it comes to his actual stock picking performance. Newsome's price target implies an upside of more than 28% in the year ahead, and no doubt more over the long haul. The best part of the UVE story is their financial strength score in the top 1% of this vital category. That includes return on equity of 28%, handily beating the industry average of 22%. They just authorized a new 20 million share repurchase program, which tells you management thinks their own stock is quite undervalued. And they've maintained a consistent dividend with a forward yield of 3.7%. The risk here is straightforward. It's a Florida-heavy insurance book. A bad hurricane season can hit results really hard. And the safety component grade from the Zen Ratings sits in the C range, reflecting the weather-related concentration risk. So you're not getting a truly defensive insurance play here, but if you can stomach a little extra risk and a little extra volatility, you can enjoy some excess reward from this deeply undervalued company. By the way, if this is the kind of analysis you want more of, things with real data, real numbers, stocks that nobody else is covering, then hit the subscribe and notification bell down below to be informed of my next research-driven stock reviews that come out every single week. Okay, moving on to stock number 3, which is where things get really interesting with Electromed with a symbol of ELMD. This is a tiny company with just over 200 million market cap. However, they've got a product with a massive untapped market. Here's the setup. There is a chronic lung condition that causes mucus buildup and makes it hard to breathe. About 923,000 Americans are currently diagnosed with this affliction, but only 16% of those patients are using the kind of airway clearance therapy that Electromed provides. Researchers estimate another 4 million people may have the same condition and don't even know about it. This provides ample growth prospects for the future. Also, their home care revenue grew over 15% year over year, and their sales reps are now producing over $1 million each annually, well above the company's target range. All this strength showed up in the most recent quarterly results. Revenue was up over 16%, handily beating consensus estimates, whereas earnings was a solid 20% beat versus expectations. The Zen Ratings is picking up on Electromed's fundamental prowess. In fact, its overall score is in the top 1% of all stocks we analyze. This includes impressive results for the component grades like top 15% for value, top 5% for safety, and top 2% for both financials and the sentiment score. It's also good to know that both of the Wall Street analysts covering the stock give it a strong buy rating, plus they have price targets that imply almost 50% upside from current levels. For safety, we have beta of just 0.46, indicating that ELMD is significantly less volatile than the wider market. That's not all it has. Next to no debt, more than 20% return on equity, 13% profit margins, and a recently authorized $10 million buyback, which for a company its size is actually quite impressive. For a microcap stock, that kind of financial discipline is rare and worth noting. The main risk here is that it's a single product company in a niche market. If adoption stalls or a larger competitor enters the space, growth could slow substantially, and the growth component grade sits in the C range right now, reflecting that while the company is growing, that growth has not been as consistent as other stocks that we track. But here's why I love this one. A pristine balance sheet, a huge untapped market, strong management execution, buybacks boosting shareholder value, and a stock price around $25. That's the kind of asymmetric setup that can deliver outsized return for patient investors. Speaking of asymmetric setups, if you want to know more about the 3 stocks I believe could double or more in 2026, I put together a free report that covers them in detail. The link is in the description, or you can scan the QR code on your screen to access it right now. All right, back to the stocks. Moving on to number 4 is Mntn with a symbol of, you guessed it, Mntn. The company sits at the intersection of two of the biggest trends in advertising, the shift to connected television and the explosion of AI-powered creative tools. Here's the pitch. Mntn is a connected TV advertising platform that lets any business run a TV commercials the same way they'd run a Google or Facebook ad. Self-serve, measurable, and completely performance-driven. They've basically taken the biggest screen in your house and turned it into a precision marketing tool. Even more amazing is their focus on smaller companies, where 97% of their customers had never run a TV ad before using their platform. Think about that, what that means. They're not stealing market share from other platforms. They're creating an entirely new category of advertisers. As you can imagine, growth is accelerating. In Q4 alone, they grew revenue 36% year over year. Active performance TV customers surged 63% year over year, showing real momentum in new adoption. All in all, CTV ad spending is projected to hit $38 billion in 2026, meaning this is a large market that they can continue to expand into. The Zen Ratings is picking up what Mntn is putting down, meaning that our quant review of the company has led to a well-deserved A rating. It also scores in the top 15% in 3 vital categories: growth, financials, and sentiment. Financially, the balance sheet is clean. They're sitting on $210 million in cash with next to no debt. Right now, 8 Wall Street analysts cover the stock. 4 strong buy, 3 give it a buy, and only 1 sees it with a hold rating. Most impressive is the average fair value price target for the year ahead, which implies upside potential of more than 120%. Even better, the street high price target implies upside of more than 250%. That comes from Tigris Financial's Ivan Feinsaif, who ranks in the top 4% of all Wall Street analysts when looking at his real stock picking results. Now the risk. This is still a relatively young public company as they recently IPO'd. The momentum component grade is a D, which means the stock price action has been weak recently thanks to a 25% dip in the past few months. That's not unusual for post-IPO names finding their footing, but it tells you the market hasn't fully bought into the growth story yet. And they're competing against some deep-pocketed players in the ad tech space. But here's the main thing. A company growing revenue at 36% with a cash-rich balance sheet, AI-powered product innovation, and the kind of market opportunity that comes from unlocking TV advertising for millions of new small business customers. Well, that's a compelling investment setup, especially at such a low price. If even a fraction of that $38 billion CTV market flows through their platform, this stock has a lot of room to run higher. And that's why so many top Wall Street analysts are pounding the table in these shares, so it's definitely worth your further investigation. Stock number 5 is Fennec Pharmaceuticals with a symbol of FENC, yet another amazingly attractive low-price stock. Every year, about 10,000 children in the U.S. and Europe undergo chemotherapy to fight solid tumors. Thankfully, the survival rates for these kids have gotten remarkably better at 85% or higher. But there's a devastating side effect. Up to 60% of these children suffer permanent, irreversible hearing loss from the chemotherapy itself. Until recently, there was nothing doctors could do about it. Gladly, Fennec's drug Pedmark is changing all of that. It's the first and only FDA-approved therapy that actually prevents this form of hearing loss in children. In clinical trials, it cut the rate of hearing loss from 60% down to just 16%, without interfering with the chemotherapy's ability to kill tumors. Analysts are now forecasting 50% revenue growth in the coming year. The company also recently reported positive results from a clinical study in Japan, supporting potential expansion into that market, which is not currently part of the healthy growth projections. Additional trials through City of Hope are exploring expanded use cases for the drug. Now, the Zen Ratings is already a big fan of Fennec, putting it in the top 5% of all stocks, solidly in that A strong buy category. It also scores in the top 5% of stocks for growth, as well as the top 15% for financial strength. There's not a ton of Wall Street coverage right now, which is often a good thing, as it means that shares are currently flying under the radar. Yet the 2 analysts on the case are some of the best stock pickers on the planet. That includes the analyst from Piper Sandler, who ranks in the top 6%, and the analyst from H.C. Wainwright, who ranks the top 1% based upon their stock picking prowess. One has a price target implying 55% upside per share. The other is pounding the table for 115% upside in the coming year. But the risks here are real. This is a single product company, so there's meaningful concentration risk, and the safety component grade is a D, the weakest of any stock on today's list. That reflects the inherent risk of a small cap pharma with revenue still ramping up. Yet all in all, the reward potential for such a low price stock is hard to ignore, meaning this is a manageable risk for more speculative investors given the growth and upside potential that may lie ahead. Our final stock is also our cheapest and perhaps the most intriguing. It's Organogenesis with the symbol of ORGO. They develop and manufacture regenerative medicine products. Now, think advanced wound care for things like diabetic ulcers, surgical applications, and sports medicine. These are products made from human tissue that actually promote the body's own healing process. The company's revenue is forecasted to grow nearly 20% in the coming year and more than 30% over the next couple years. Yet that doesn't take into account that they have expected regulatory approvals and new product launches coming in early 2027 that could accelerate things much, much more. The Zen Ratings system gives ORGO an A overall rating, which is a firm strong buy recommendation. And as we drill down, it gets even better as the growth component score of A puts in the top 2% of all stocks, confirming the consistency of past growth and the prospects of what lies ahead. And the sentiment score of A tells you the smart money is lining up behind this name as well. In the smart money camp is top analyst Ryan Zimmerman of BTIG with a strong buy recommendation with a price target that represents upside of more than 140% from current levels. There are some real downsides to consider here. ORGO only gets a C for value and financial safety momentum. It ranks near the midpoint in these areas. Momentum is a tad better than that. At the end of the day, it's a low-price small cap, so you're dealing with extra volatility on a day-to-day basis. But here's the bottom line. This is a real business generating nearly $500 million in revenue. The growth is accelerating. Strong Zen ratings for fundamental strength and the seal of approval from one of Wall Street's best analysts. For investors who understand small cap risk and are willing to be patient, this is exactly the kind of special opportunities the Zen rating system was built to discover before the rest of the investing world catches on. So which of these 6 stocks do you find the most interesting? Just drop a note in the comment section below. And if you think I missed something, maybe a risk I didn't mention or another stock that you like under 35 that you like even better, I want to hear that too. I read every comment, and often the best stock ideas come from our community. And if you're interested in my highest conviction long-term stock picks, then check out the video that's popping up on your screen right now. I review some special stocks that could be big winners over the next 10 years, and the time to invest in them is now.